if you look at real public demand, right? Look at the ETF GLD.
Mm-hmm.
Americans have been net sellers. So the whole time gold rallied from 2000 to 2400, which was a 20% move in under 4 months. That's a huge move for gold. I mean, maybe not for Bitcoin, but that's a big move for something like gold. And especially with the market cap. I mean, because gold has a much bigger market cap. So gold moving up 20% is like Bitcoin quadrupling or something like that. I mean, there's a lot of market cap there.
Sure.
So despite the fact that gold moved up 20%, retailers were selling the whole time. They kept liquidating their gold holdings. And, you know, I have my backdrop up for Schiff Gold. You know, that's my gold business. And, you know, we're pretty good, you know, taking the pulse of the market. And, you know, we talk to the wholesalers that we buy from, and they sell to our competitors as well as us. And business has not really picked up much. You know, it's a little bit better, but not significantly better. So it's not like all of a sudden the public has got gold fever and they're rushing to buy. They're not. The buyers have been foreign, and a lot of it is central banks, Eastern central banks, emerging market central banks that have been the big buyers of gold. And that's why it keeps going up, even though a lot of retail has been selling and the institutions have been missing in action. In fact, just a few months ago, before the huge run up, the big Wall Street firms were downgrading the gold mining stocks because they saw no upside in gold just before it took off. And so the question is, why are these central banks buying gold? Because, you know, they could be buying dollars and holding U.S. treasuries and getting 5%. But why are they turning that down and owning gold and getting 0%? And I think it's because they can read the writing on the wall. They don't have confidence in the fiscal, you know, responsibility of Congress or the ability of the Fed to fight inflation. And they're voting with their feet. They're selling their dollar assets and they're increasing their gold reserves. And I think this trend is going to continue. This is the de-dollarization. And central banks are moving out of dollars and also to a lesser extent out of euros, out of yen and pounds. And they're moving more into real money. They want to back up their own currencies with money rather than another fiat currency that's backed by nothing. So this is the beginning, I think, of that trend. It's got a long way to play out because the central banks still way under own gold, especially the central banks that have been buying.
In a recent analysis, renowned economist Peter Schiff delves into the dynamics driving gold's potential for substantial price appreciation. Despite a remarkable 20% surge in just 4 months, Americans have been net sellers of gold, reflecting a broader sentiment shift. Schiff notes that while this rally may seem modest compared to Bitcoin's volatility, it's significant given gold's market cap. Central banks, particularly in emerging markets, have emerged as major buyers, reflecting a lack of confidence in fiat currencies and the ability of central banks to combat inflation. This trend signals a potential paradigm shift, with gold increasingly viewed as a reliable store of value.
The Western central banks have much greater gold reserves as a percentage of total reserves than emerging markets. But the emerging markets have all the reserves. They have much more in the way of foreign exchange reserves than the big countries. And so this is a major shift. And, you know, it's unfortunate because you've got so many Americans who have been buying Bitcoin or these Bitcoin ETFs, and they're selling their gold in order to do it. And so you have the Eastern central banks taking advantage of this. They're buying the gold that Americans are selling. And this is a negative development because it's basically a flow of wealth leaving the U.S., going to China, going to India, or wherever the gold is being bought, and Americans are just stuck with nothing. Well, I mean, it's not suppressed by some kind of grand conspiracy. I think it's suppressed simply because enough people in the private sector don't recognize its true value because they still have confidence in central banks. They still believe that inflation is not a threat, that the Fed has extinguished it, and they would rather invest in growth stocks. You know, it's like there's an opportunity cost to having your money in gold. I mean, I can't have it in a Magnificent Seven. And so people are still very risk seeking. They don't have a lot of fear or concern about inflation or a debt crisis. I mean, we've gone on for so many years, supposedly, and nothing as bad has happened, even though a lot of bad things have happened along the way. They just don't recognize it or know to what to attribute it. But yeah, you don't have the type of demand that we should have from investors for gold. Certainly the institutions should be buying gold. Pension funds, endowments, hedge funds should own some gold. I mean, they shouldn't be all in gold, but they should have 5% in gold. I mean, they have nothing in gold. And the same thing for most, most individual investors have no gold, right? I mean, they should have some gold. And if a lot of the people who have no gold decided they wanted to buy a little bit of gold, that would send the price up a lot. Well, I have a lot, but it's mainly because I own gold mining stocks.
In a follow-up, Peter Schiff discusses his investment approach, splitting his portfolio between physical gold and silver and precious metals mining stocks. He predicts a bright future for gold mining stocks, driven by inflation-induced mining cost hikes. Schiff highlights the potential for undervalued gold assets to gain value if gold prices outpace mining costs, offering investors a compelling opportunity. Contrasting this with Bitcoin's high volatility, Schiff advises caution. Despite possible losses, he sees gold stocks as offering better potential gains over Bitcoin, making them a favorable choice for risk-aware investors seeking long-term growth.
I mean, I own physical gold and silver, but I have half my portfolio, which I don't include the gold and silver in my portfolio. I look at my gold and silver as savings. Like instead of money in the bank, I look at it as, gold in a vault, right? So that's kind of my safe haven money, my savings. But I own a lot. I have 50% of my investment portfolio is in precious metals mining stocks. And so indirectly, when you own a gold mining stock, you own the gold that's in the ground that hasn't been mined yet. And so some of that gold belongs to me as a shareholder, and it's going to be mined in the future and sold at what I believe is going to be a much higher price. And in fact, I think that gold mining stocks have been an ironic victim of inflation, because inflation has driven up the cost of mining dramatically over the last decade. It's so much more expensive now to mine an ounce of gold than it was, because the costs have gone up so much because of inflation. The raw materials, the labor, everything. But because investors don't appreciate how bad the inflation problem is, they haven't bid gold up, commensurate with the cost of mining it. And so that has bitten into the profits of these gold mining companies. But what I think is going to change over the next several years to decade is gold is going to outpace the cost of mining it. And so the margins are going to explode for these gold mining companies. And what's going to really cause the big gains is that a lot of the gold that the market is assigning no value to is going to suddenly have tremendous value. For instance, if an analyst that works at a Wall Street firm has a long-term forecast and thinks that the price of gold 10 years from now is going to be 1,700, which is what they generally think, because they always think price is going down, but the cost of mining is going to keep going up, you're not going to have a big earnings estimate. But let's say a gold company has a major deposit of gold, but it costs $2,000 an ounce to get it out of the ground. Well, if Wall Street is assigning a $1,700 gold price, then that asset has no value. The mine is, they're never going to extract the gold because they would lose money on every ounce. And so, losing money on every sale may be good business if you're a tech stock and no one gives a damn. But if you're a real business, losses aren't good. But let's say all of a sudden the gold price is 5,000, and maybe the cost goes up from $2,000 an ounce, maybe even to 3,000, right? But if gold can be sold for 5,000 an ounce and it costs you $3,000 to get out of the ground, that's a very valuable asset, because the company is going to earn $2,000 for every ounce they mine. And so now something that had no value on the balance sheet could have billions, depending on how much gold they can extract at $2,000 an ounce profit. So I think a lot of these stocks are just going to just explode. And that's why I have such a big percentage of my portfolio. Now, of course, I've been waiting this out for a long time. right? It's not like I just started buying these stocks. I've been buying them for over a decade. And so I've been buying more when the prices were down. And then whenever the prices really rally, I stop buying and I buy other stocks, right? Because I try to keep it at about a 50-50 between precious metals and more traditional dividend paying value type stocks that have nothing to do with gold and silver. But I think to the extent that you've got it, your audience and they're risk seeking and, they're gambling on Bitcoin, personally, if you want to gamble, if you want to make the moonshot, right? If you want to buy the Lambo and make 10 times, 20 times, 50 times your money, the odds of doing that in Bitcoin are extremely remote. Whereas the decline, the possibility of a 70, 80, 90% decline in Bitcoin, I think is real, pretty substantial. So I don't see that the risk, that the reward is worth the risk. Whereas with gold mining stocks, can you lose half your money in gold mining stocks? Yes, you could. I think the odds, though, are less that you'll lose half your money in gold stocks than you'll lose half your money in Bitcoin. But on the other hand, I think gold stocks have a much better chance of going 10x, 20x, even 3x than Bitcoin does.
Thanks for tuning in to today's segment, where Peter Schiff shares valuable insights into the dynamics of the gold market and investment strategies. Here's a quick recap. Despite a 20% rally in gold prices, Americans have been net sellers, while central banks, especially in emerging markets, are buying gold as a hedge against uncertainty. Schiff emphasizes the undervalued potential of gold mining stocks, driven by inflation-induced cost hikes and overlooked reserves. He contrasts this with the high-risk nature of Bitcoin, advocating for gold stocks as offering better odds of substantial gains with controlled risk.